Hi everyone. Today we're going to be discussing the section on inventory. This is theme 1. Hey, the learning outcomes. So by the end of this learning unit, you should be able to explain why some businesses choose not to use a perpetual inventory system, but a periodic system instead. We did touch on inventory systems in learning unit 2. If you have forgotten, you can go back with your textbook and you can recap what we've done. We discussed the differences between a perpetual and periodic inventory system. So just to remind you, a perpetual system is the one that we've been using all along. That's where inventory is constantly updated as we buy and sell inventory. So at any point in time, we'd be able to look at the cost of our inventory at any time in the year, right? With a periodic inventory system, you only calculate the cost of sales at the end of the year once a stock take is done. Okay, calculate cost of sales using a periodic inventory system. We will discuss that in this learning unit as well. Demonstrate the working of the purchases and purchasers returns accounts under a periodic inventory system. Demonstrate the working of the carriage and purchases. Remember, carriage and purchases is your transport, also known as transport inwards, and similar accounts that affect the calculation of cost of sales under a periodic inventory system. Analyze inventory-related transactions under the accounting equation when using a periodic inventory system. We did this in detail in Learning Unit 2, so you can go back and recap this there. Okay, record the inventory-related transactions in the subsidiary journals when using a periodic inventory system. So we're going to look at the CRJ, CPJ, etc., and the differences between recording with a periodic and a perpetual inventory system. Okay, explain which one of the two inventory systems is most desirable in the world in which we live. Okay, so definition, your inventory textbook definition. Inventory is an asset that's held for sale in the ordinary course of business. So everyone already knows what's an asset. We discuss this in class very often, right? So inventory is an asset. Just to recap, an asset is a resource controlled by the entity as a result of a past event that will bring money into the business, right? An inflow of benefits to the business. Right, so it's held for sale in the ordinary course of business in the process of production for such sale. In other words, it's something that you can be producing. So maybe if you're manufacturing tables, something that's in the production process. So it's not a completed table, it's halfway complete, but it would still be considered inventory, or in the form of material to be consumed in the production process or rendering of services. So it could be material that you're using to manufacture the table, maybe the wood. So you've purchased raw material, you've purchased wood. That would also be considered inventory. Okay, the calculating the cost of inventory. In Learning Unit 2, you're briefly introduced to the concept of inventory and you learned about two types of inventory system, where you spoke about the perpetual and periodic. So now we'll look at how the cost of inventory is calculated and explore the impact of the perpetual and periodic systems on recording of information in the cash and credit journals as well as the general ledger. Okay, so the initial measurement of inventory. Initially measured at cost, which includes costs incurred to bring the inventory to a location and condition for sale. So any cost in bringing your inventory to your shelf, so to your store shelf, that would be included in the cost of inventory. Example, transport costs, bulk and trade discounts, import tariffs, insurance costs, and transfer duties. Remember, transport costs in bringing the goods to you are included in the cost of inventory. If you are paying for transport to send it out to the customer, that would not be included in the cost of your inventory. The customer would need to pay for that. Okay, cost of inventory includes only costs incurred to get the inventory ready for sale, not the cost incurred after the inventory has left the shelf. Example 6.1 on page 183. Gentile Furnishes imports an expensive lounge suite from Canada to be sold to a client in South Africa. The regular price of the lounge suite is 30,000 Rand, before a trade discount of 5%. Other costs include transport costs inwards of 3,000 Rand. That means they're paying to get the lounge suite to them, and import duties of 1,500. The cost of trading inventory can be calculated as follows. Okay, we can ignore that. So the normal purchase price, you paid 30,000 for it, but you're given a 5% discount. So you need to remove that trade discount. So 5% of 30,000 is 1,500. So the net purchase price is actually 28,500. So that's after your 5% discount. Then you need to include the transport cost. So transport inwards was 3,000. So you'd add that. Import duties of 1,500. You'd need to add that as well, because these expenses were necessary in bringing the inventory to your store. So it must be included in the cost of inventory. So the total cost of your trading inventory is now 33,000 Rand. Okay, I'd like you to complete question 6.1 on page 182 of your textbook, and to also complete question 6.2 on page 184 of your textbook. And then we will meet back at the CoLab session where we're going to be discussing these questions. I'll see you soon.